Most people look at real estate and see buildings, a house, an apartment complex, an office tower, a warehouse, maybe a piece of land sitting empty beside a growing city. But experienced investors look at something completely different. They see a machine that can turn one piece of property into multiple streams of money. And the most interesting part is that the building itself is only one piece of the equation. Imagine you find an empty parcel of land. Right now, it might not look like much. No tenants, no rent, no building, no cash flow. Yet two developers can look at the exact same property and see completely different futures. One sees cheap land, the other sees apartments. The difference is not the dirt. It is what the land can legally and economically become. That is where the real estate business begins. Location comes first. Access matters. Nearby roads matter. Infrastructure matters. Jobs matter. Population growth matters. And zoning may matter most of all. A property near a growing business district can become far more valuable as development moves toward it. A parcel near a new transportation route can suddenly attract buyers and developers, but a piece of land with strict zoning restrictions may remain limited no matter how attractive the location appears. So the first real estate question is not, how much is this land worth? It is, what can this land become? That question can determine the entire project. Once the right property is found, the next challenge is buying it, and this is where real estate becomes a capital business. Developers may use their own money. They may borrow from banks, they may bring in investors, or they may combine all three. The objective is to control a valuable asset without putting all of their own capital into one deal. That is leverage. A smaller amount of personal capital controls a much larger property. When the project succeeds, that can dramatically increase the return on the investor's own money. But leverage works in both directions. If financing becomes expensive, if construction runs late, or if the finished property sells for less than expected, the debt does not disappear. The bank still wants to be paid. That is why successful developers aren't simply asking how much money they can borrow, they're asking how much debt the project can safely support. Then comes the part most people never see. Zoning. You can own the land, you can have the financing, you can have the vision, and you can still be unable to build what you want. Zoning laws can determine whether the property becomes a house, an apartment building, an office, a retail center, or an industrial facility. They can also control height, density, size, parking, and development rights. That means a zoning change can create enormous value before construction begins. The land didn't move, the building didn't change, but its potential did. And potential is what developers are often trying to buy. Once approvals are secured, construction begins. Now the empty land becomes something people can actually use. Money flows into materials. Workers, contractors. Engineering, equipment, permits. And every delay becomes expensive. A project that should take months can stretch much longer. Material costs can rise. Contractors can run into problems. Financing continues accumulating, and every extra month reduces the developer's margin. But when everything is controlled properly, something powerful happens. The completed property can be worth substantially more than the combined cost of the land and construction. That difference is where development profit begins. But the building still isn't finished as a business, because a property needs an environment around it. Roads. Electricity, water, drainage, parking, access, public spaces. Infrastructure determines whether people can actually use the property. A beautiful building with terrible access can struggle. A strong development surrounded by reliable infrastructure can attract buyers and tenants much faster. And that leads to the next part of the machine. Demand. A developer can build something excellent, but if nobody wants it, the project has a problem. That's why marketing matters. Property listings, showrooms, social media, advertising, real estate agents. Every one of these tools exists to answer one question. How quickly can we turn this property into revenue? Some developers go one step further. They sell before construction is finished. Pre-sales allow buyers to reserve properties while the project is still being built. Deposits and installments bring cash into the project earlier. That can reduce the amount of outside financing required. But it also creates a promise. The developer must finish the project. The property must match what was sold, and the buyer must receive what was promised. Because eventually, the property has to become more than a construction project. It has to become a source of money, and this is where real estate becomes much more interesting. Because there isn't one way to make money from the same property. You can sell it, or you can keep it. If you sell, the buyer gives you a large payment. That payment must cover the land, construction, financing, infrastructure, marketing, and every other project expense. Whatever remains becomes profit. But keeping the property creates a completely different machine. Now the property becomes a rental asset instead of one large payment. You receive smaller payments every month. That is recurring cash flow. An apartment building can produce rent. An office building can produce rent. A retail property can produce rent. A warehouse can produce rent. The building remains yours, and if rental income stays above operating expenses and debt payments, the property can continue producing cash flow year after year, but rent isn't passive. Someone has to find tenants, collect payments, handle repairs, maintain common areas, keep occupancy high, deal with problems, and protect the condition of the property. That is why property management matters so much. Poor management can destroy the economics of a good property. Good management can turn an ordinary asset into a reliable income producer. Then the type of property changes the business again. Commercial real estate depends on business tenants. Retail depends heavily on foot traffic. Industrial property depends heavily on logistics. A warehouse near highways, ports, and major cities can become extremely valuable because businesses are paying for access as much as they are paying for space. And long-term commercial tenants can create predictable income. But an empty commercial building creates the opposite. Little revenue, still carrying costs, still taxes, still insurance, still maintenance. This is why occupancy is one of the most important numbers in real estate. Then comes the force that can completely change the financial outcome: interest rates. Most investors use mortgages. They put down part of the purchase price. The bank finances the rest. That allows them to control a much larger property with less of their own money. But the loan never stops demanding payment. When interest rates fall, financing becomes cheaper. Monthly payments decrease. More buyers can afford property. Demand can rise. When rates increase, financing gets more expensive. Cash flow gets squeezed. Buyers can afford less, and property values can weaken. One change in borrowing costs can affect the economics of an entire market. But real estate has another advantage. You don't always need to sell the building for it to become more valuable. Property can appreciate as cities grow. Populations increase. Jobs move into new areas. Infrastructure improves. Demand expands. A property bought at the right price can become substantially more valuable simply because the surrounding area changes. And investors can create appreciation themselves, renovate the building, improve amenities, reduce vacancies, increase rents, upgrade the property, make the asset more productive. Higher income can increase the property's value. That creates a powerful cycle. Improve the building, increase income, increase value, then potentially refinance. Instead of selling, an owner can borrow against the increased value, use the new loan to repay the old one, and potentially unlock some capital while still owning the property. That creates another opportunity. The capital can potentially help fund the next investment. Meanwhile, every mortgage payment gradually builds equity. Equity is simply the property's value minus the debt still owed. As the loan balance falls, equity rises. If the property value rises too, equity can grow even faster. That is how a relatively small initial investment can become significant wealth over time. But there is another side to the equation: taxes, maintenance, vacancies, insurance. These costs never disappear. A roof eventually needs repair. A plumbing system eventually fails. A tenant eventually leaves. A storm can cause major damage. Property taxes arrive whether the building is occupied or empty. Insurance protects against catastrophic events, but it is another cost the owner must carry. Then there is market risk. Real estate moves in cycles. Strong economies create jobs and demand. Recessions can weaken occupancy and rents. Developers can build too much. Supply can exceed demand. And when that happens, landlords compete for tenants. Vacancies rise. Prices can fall. That is why the smartest investors don't simply chase rising markets. They build properties that can survive difficult ones. And eventually, the goal becomes bigger than owning one property. One property produces cash flow. That cash flow can help support the next purchase. Equity can create access to new capital. Refinancing can potentially unlock money without selling. The second property creates more income, then more equity, then another opportunity. One property becomes two. Two become several. Several become a portfolio. At that point, real estate stops being a single investment and it becomes a business. Now management becomes critical. More tenants, more repairs, more leases, more expenses, more decisions. Some investors manage everything themselves. Others hire professional property managers. The method can change. The objective does not keep occupancy high, keep expenses under control, keep cash flow moving, and protect the value of the assets. But you don't even have to own the entire building yourself. Real estate investment trusts allow investors to participate in income-producing real estate through a larger pooled structure. The property produces rent. Investors own shares, and part of the income can return to shareholders through dividends. That means real estate can be approached from several directions: development.sales.rent, cash flow, appreciation.equity, refinancing, portfolio growth, or REITs. And that is the real secret. Real estate isn't powerful because buildings magically become valuable. It is powerful because one asset can create multiple economic outcomes at the same time. The land can appreciate. The building can generate rent. The mortgage can build equity. Improvements can increase value. Leverage can amplify returns. And one successful property can potentially help finance the next. But none of it is guaranteed. Debt can become expensive. Vacancies can destroy cash flow. Repairs can consume profits. Taxes reduce what investors keep. Interest rates can change. Markets can fall. Supply can overwhelm demand. So the real business of real estate is not simply buying property. It is controlling the numbers around the property. Buy at the right price. Choose the right location. Understand what can legally be built. Use leverage carefully. Control construction costs. Create demand. Protect occupancy. Manage the asset. And know when the market has changed. Because the best real estate investment isn't necessarily the biggest one. It is the one where the numbers continue working when conditions stop being perfect. That is how an empty piece of land can become a building. How a building becomes cash flow. How cash flow becomes equity. How equity becomes another property. And how one property can eventually become an entire portfolio. Once you understand that, you'll never look at real estate the same way again.